We've got to bear in mind, markets are going to be relatively thin volume. We might see some more outsized volatility as people take a break, but it's a good, difficult end to 2021.
Well, certainly. I mean, I think the markets were a little bit complacent. I mean, we have a number of crosswinds that we're just dealing with over the past several weeks. Obviously, it looks like we will have a little bit less fiscal policy. The monetary policy has clearly pivoted to a little bit more hawkish stance. And then finally, most importantly, and unfortunately, we have the Omicron variant to deal with. So when you put that all together, I think the markets were just a little bit vulnerable. But I think it's important, to really think in 2022, how do the fundamentals of the global economy hold up?
How do they hold up?
Well, I think they certainly will hold up. I mean, I think the one fortunate theme is that going into the year, into this new year, the major developed markets have some considerable underlying strength. I mean, we were undoubtedly going to see a deceleration in growth. That's not a bearish sentiment. It was just acknowledging how high we were this current year. But we look at the labor market in Europe, certainly in the United States, and I think that ultimately will carry the day. I mean, things would have to get materially worse on a number of fronts for anything to really derail the recovery in 2022.
But with economic growth slowing and projections coming down like Goldman had made today, how does that not start to derail some of the headwinds we've seen, particularly in the job market?
Well, I think we were going to see a growth scare. It's something we have talked internally at Vanguard for a little time. I think we will see a little bit increase in consumer hesitancy, perhaps in the first quarter. We will obviously even have a little bit greater drag in terms of fiscal cliff. But I think even if you're a little bit more on the pessimistic side, you're still talking roughly 3% growth at the low end for 2022. That's certainly above trend, and it will be consistent with a labor market that will continue to add jobs. I mean, the backlog of existing openings is still significant, and which means that by this time next year, the unemployment rate will be lower, wages will be higher, and that's a certain ballast to consumer spending.
You mentioned, of course, developed markets there, Joe. I'm interested in your take on emerging markets. Of course, there's the ongoing headwinds of what the U.S. monetary policy system looks like, but also idiosyncratic news. We've just been seeing the moves in the Chilean peso at the moment, the leftist Boric winning the presidency over there, and we see significant moves, Chilean peso closing at a record low after that leftist win. How much do you think eventually we might start to see money move into emerging markets, that more risk-on attitude into 2022?
I think eventually, but I think we still have to go through. I mean, again, emerging markets, I think there's just mixed news. I mean, I think you certainly have some economies benefiting from just robust demand across the developed markets, but they are also plagued, some markets, with high inflation problems. We've seen that in Latin America, and some parts of the market are actually not as compelling from a valuation perspective as you would think. I mean, I think by far the most important factor, in addition to Omicron, is really just the health of the Chinese market. I think there's modest downside risk to China. I think the real estate weakness, as well as the regulatory tightening, in addition to the zero COVID policy, all may be a little bit of a headwind, certainly in the first half of the year. I think if we look in the second half of the year, it's a little bit more constructive, I think, for markets in general.
Is that still an EM ex China strategy then?
Well, again, I think there, you have to even look at it even more segmented, a little bit more segmented. I mean, I think if you look at areas such as Mexico, obviously they're going to continue to benefit from robust demand, particularly in the United States. So again, I think it does depend upon the market. We have a commodity market that, will probably see a lower inflationary trajectory, even if demand holds up. We will have modest improvements in the supply front if we are right in our forecast. So again, I think it does depend on the market we're talking about, but if you add them all up, if the consensus forecast that the markets are expecting are even vaguely accurate, then that should be modestly supportive for EM going forward.
Joe, how concerned are you about the ability of central banks outside of the U.S. to get a handle on inflation?
Well, I think if we're looking over the next 2 or 3 years, I'm fairly confident that central banks will keep a lid on inflation. I think what the bond market may be underestimating, maybe not for 2022, but a little bit beyond that, is how high the Federal Reserve, I'll use the Federal Reserve as an example, how high the Federal Reserve may have to go to temper wage pressures. We have increasingly an outlook where the Fed may have to go as high as 3%. That's not this. This is not for 2022. So I think the market may have gotten a little bit ahead of itself for 2022. But again, if we're right in terms of the labor market fundamentals, that will continue to lead to wage pressures, which is good for the recovery. But it also means that the Federal Reserve may have to raise rates a little bit more aggressively over the next 2 or 3 years than the bond market expects.
Than the bond market. And meanwhile, we have to remember, yes, it's a down day in terms of stocks, but how far we've climbed, up 21% on the S&P 500 year to date. Joe, your last thought on where to put your money right now as a head of investment strategy, of course, at Vanguard. Are you changing any of your opinions when we get news today, like Omicron and like the lack of the Build Back Better plan by the end of the year?
Well, I think we've been underscoring two messages. One is to stay invested, which sometimes, given the high valuations, certainly in the United States, in the developed markets, you can have investors that question that. You also have, the news that buffeting investors all the time. So one is to stay invested. Secondly, is to think about areas that have not participated as much as the returns of the past 3 or 4 years. So what would they include? They would include areas outside of the large cap space where if we believe in the global recovery with some volatility, it would be supportive of those parts of the market and those markets outside the U.S. So again, I think it's to stay invested, even if we're talking about modestly lower returns over the next several years.